Welcome back to the Deep Dive. Today we're taking a fascinating look at a business model that's just, well, a marvel of compounding and efficiency.
Yeah, we are.
If you've ever wondered how serious wealth gets built systematically over decades, we're unpacking LIFCO-A.B. It's this high-powered serial acquisition machine, basically, coming out of that whole Nordic ecosystem.
That's a great way to put it. LIFCO is really a masterclass in what people call the Swedish serial acquirer model, but it's more than just buying companies, right?
Right.
It's about this almost philosophical commitment to how they manage them, or maybe, how they don't manage them.
Oh, yeah, the lack of management.
Exactly.
Yeah.
So our mission today for you is really to get under the hood of this model. How does a company oversee, over 257 different businesses?
257, yeah.
With a head office staff that's barely big enough to run a decent-sized coffee shop. And also, what are the recent signals telling us? There's been market noise, cyclical stuff, but also some really aggressive insider buying. What does that tell us about their conviction?
I like that focus, especially on the structural side. It's just the complete opposite of what you picture, right? The giant corporate HQ.
Yeah.
And this core philosophy, the identity they pitch to sellers, it's right there up front. They're not just buyers. They want to be seen as a safe haven for entrepreneurs.
Exactly. And that philosophical bit, it's probably their single biggest strategic weapon. LIFCO's whole identity is built on this perpetual owner principle. Their stated policy, it's like ironclad. They never buy companies with the intention of divesting the business, period. Permanent ownership.
Never divesting. That really hits differently than traditional private equity, doesn't it?
Yeah.
E-firms, they have to sell. Their fund structure demands it, usually, 5-7 years?
Yeah.
They're always grooming for the next sale.
Always.
LIFCO's saying, nope, we buy it, we keep it, and those earnings, they just feed our compounding machine forever.
And look, this buy and hold forever thing, it's not just some nice marketing line. It's a really crucial soft asset. It seriously boosts their deal flow. The sources we looked at emphasize this promise is often, quote, crucial in persuading entrepreneurs to sell their life's work to them.
Yeah, you can see why.
Think about it. You're a founder. You care about your town, your employees, the brand you built over maybe 40 years, selling to PE. Okay, maybe you get top dollar, but it's getting flipped again. Selling to LIFCO. That's about legacy preservation. That gives LIFCO a huge edge in finding those really good private companies, the ones where maybe stability matters more than squeezing out the last krona.
That makes total sense.
Yeah.
They're competing on culture, on stability, not just price. Okay, let's unpack this engine room then, because the operational structure here is, well, it's almost hard to believe. How does a company this big, 257 operating units, 34 countries, how do they run that?
Through just extreme radical decentralization. It honestly sounds a bit nuts until you look at the numbers. This huge group, right, over 7,000 employees globally,
7,000.
is overseen by a headquarters staff of only about 35 people. 35 full-time employees.
35. Seriously, 35. That's incredibly lean. That implies no massive central IT department, no big treasury team, no sprawling audit function, and famously, you mentioned, no central human resources department for 7,000 people.
Nope.
How do they even handle the basic legal and regulatory stuff across 34 countries with 257 different entities? Doesn't that just scream risk? Massive unforeseen risk.
So that's the constant tension, isn't it? And it's a risk they seem to manage through being incredibly picky about what they buy and having really rigid procedures, not by throwing bodies at it centrally. The CEO, Per Waldemarsson, he basically sees centralization as the enemy. His main job, as he puts it, is to protect his team from bureaucracy.
Protect them from the head office, essentially.
Pretty much. The input from the center is so minimal. He's even said he limits his opinions on subsidiary matters to a maximum of 2 things at any time. All the real operational calls. They're made locally by the management teams who actually know the niche, know the market.
Okay, I'm starting to see the genius in the constraints here. This radical leanness isn't just about saving money on fancy offices or avoiding red tape. It actually works as an involuntary M&A filter. The structure itself dictates what they can even consider buying.
Precisely. Because the parent company is basically just a capital allocation hub with almost zero operational muscle.
Yeah.
Just those 35 folks LIFCO is structurally incapable of buying fixer-uppers. They can't do turnarounds.
Right.
Think about it. If they found some big manufacturing plant, maybe outdated tech, bloated inventory, weak management team, that's prime territory for a PE turnaround specialist, right? Send in the consultants, the finance SWAT team. LIFCO couldn't touch it. They literally don't have the people or the mandate to go in and do that kind of heavy operational lifting. If a target needs deep restructuring or has a weak management team, LIFCO just can't fix it from the center. So this forces discipline in their M&A. They absolutely must buy right. They have to acquire businesses that are already high quality, already profitable, already leaders in their niche, and crucially, already have strong, self-sufficient managers. Otherwise, the whole model just falls apart.
So their weakness, the tiny HQ, is actually their strength because it forces them to target only the most resilient, well-run businesses. That's a fascinating built-in risk control. And this philosophy continues after the deal closes with what they call the non-integration playbook.
That's right. And the playbook is explicitly against trying to find operational synergies. No merging sales forces, no relocating factories, no centralizing marketing. They want to keep that unique entrepreneurial spark and the brand identity of the company they just bought.
Okay, so if they're not integrating operations, what do? What are these 4 steps they take when a new company joins the LIFCO family?
It's really about governance and financial alignment. It's designed to efficiently harvest that cash flow while leaving the day-to-day operations alone. Step 1 is governance. They appoint a new board for the subsidiary, usually led by a chairman with deep experience from somewhere else within the LIFCO group network. This gives high-level oversight and accountability, but without meddling in daily operations.
Guidance, not micromanagement. Okay, what's step 2?
Step 2 is immediate compliance. The new company has to adopt LIFCO's strict code of conduct and financial reporting standards right away. Get everyone on the same page, ethically and financially.
Makes sense.
Then step 3, financial discipline. And this is maybe the most critical part from a compounding perspective because it's how they ensure capital efficiency. They bring in new reporting systems, new ways of measuring performance, new bonus structures, and a really intense, increased focus on financial awareness, particularly on working capital.
Okay, let's pause on that working capital piece because that seems absolutely key to how they generate cash. If they're not messing with products or sales strategies, what exactly are they targeting financially at the subsidiary level? What KPIs are they pushing?
They're essentially just optimizing the cash flow tabs. When a founder-run company becomes part of this capital allocation machine, LIFCO immediately goes after the common inefficiencies you see in private businesses. That usually means hitting receivables hard, getting paid faster, and optimizing inventory levels.
Right.
They really zero in on metrics like day sales outstanding, DSO, how fast can you collect your cash, and inventory turnover. Is money tied up in stuff sitting on shelves? LIFCO pushes the local teams to squeeze that working capital. They leave the core operations alone, but they are ruthless about optimizing the capital efficiency of those operations.
That's a really important distinction. Improve the cash generation mechanics without breaking the underlying business model.
Yeah.
Okay, and the 4th step.
The 4th step is strategy. The local management team, now reporting to this new LIFCO-appointed board, has to prepare short-term and long-term strategic plans. And crucially, these plans now have to include sustainability metrics. This ensures the new company is thinking long-term, aligning with that whole perpetual ownership idea.
Okay, 257 companies. That's just a huge number. They need some way to organize this portfolio. You mentioned they group them into 3 main business areas. Let's look at that segmentation, because it probably tells us a lot about how they've grown.
It does. The 3 areas, using the 2024 sales figures, break down like this. Dental, which is about 24% of sales, then demolition and tools, about 25%. And the biggest chunk is system solutions, coming in at 51%.
Okay, dental and demolition and tools. Those sound like pretty specialized verticals, maybe areas where they started or built deep expertise.
That seems likely. The dental segment, at almost a quarter of the business, is super resilient. People need dental work, recession or not. So it includes things like distributors, but also manufacturers of higher margin stuff like specialized orthodontics, implants, and even proprietary dental software. Very stable, high-value niches.
Makes sense. And demolition and tools.
That's the other 25%. This focuses on really niche equipment for specialized construction and infrastructure jobs. The star here is their brand, Brock. They're the world leader in making demolition robots. Again, highly specialized, high-margin machines, not commodity tools.
Right, so both of those are pretty defensible niche dominant sectors. But then you get system solutions. That's over half the company, 51% of sales.
No.
That name sounds, well, it sounds like the capital allocation model is running wild, totally unbound by industry.
That's exactly what it is. System Solutions is this huge, incredibly diverse catch-all segment. It's basically the proof that LIFCO could scale its M&A model horizontally. As long as a target company meets their strict buy right criteria, profitable, niche leader, good management, asset light, it doesn't matter what industry it's in, it can land here.
And it's broken down even further.
Yeah, into four main divisions within Systems Solutions: contract manufacturing, environmental technology, infrastructure, and then special or transportation products.
Give us a feel for the kinds of businesses hiding in Systems Solutions. Since it's half the group, what sort of specialized niches are they snapping up left and right?
Oh, the variety is just incredible. Under contract manufacturing, you might find, say, a company making hyper-specialized components for medical devices or maybe defense applications. Businesses where precision and quality are everything, not mass production.
Right, critical but maybe low-profile suppliers.
Exactly. Then in environmental technology, they could own companies focused on like high purity water filtration systems for labs or specialized waste handling for tricky industrial chemicals. Again, niche essential services.
Okay.
And under special transportation products, you might find a firm like Maxi Mover, which they bought recently. They do highly customized low floor van conversions, for accessibility, or maybe manufacturers of very specific bespoke trailers for hauling heavy industrial equipment. System Solutions is basically the evidence that the model is industry agnostic. If it's a great niche business, generating cash, run well locally, LIFCO can find a home for it here.
Okay, this brings us neatly to the wider context.
Yeah.
LIFCO didn't just invent this out of thin air, right? It's part of this broader regional thing, the whole Swedish serial acquirer ecosystem.
Absolutely. LIFCO is definitely a star player, but it's part of this bigger constellation in the Nordics. You've got other really successful companies doing similar things like Indutrade, Lagerkrantz, AdTech. It's a model that's just uniquely prevalent and incredibly effective, particularly in Sweden.
Why Sweden, though? We hear about this model being so common there, but what is it about the Nordics, or Sweden specifically, that allows this kind of radical decentralization to thrive?
Well, the common thinking points to two main factors, and they're kind of interlinked. First, there's the cultural bedrock. It's generally considered a high-trust society. And think about it, this extreme decentralization, basically handing over the keys to local managers, maybe thousands of miles away, that's incredibly risky if you don't have a high degree of trust.
You'd need layers and layers of central oversight otherwise.
Exactly. In a low-trust environment, the head office would constantly be worried about mismanagement or worse, so you could argue that high trust is almost a prerequisite for LIFCO's super hands-off style to even function without massive risk.
That's fascinating. A cultural moat protecting the financial model.
You could say that. And the second factor often mentioned is that Sweden tends to have a simpler, maybe faster M&A environment for private deals, especially in that middle market where LIFCO hunts. This helps these serial acquirers keep up their deal speed, that velocity, and maintain their pricing discipline, which is absolutely crucial for the compounding to work year after year.
Okay, so you mentioned peers like AdTech. If they're all doing this serial acquirer thing, how does LIFCO's radical approach compare? Is it really that unique or just a bit more extreme than the others?
No, LIFCO is definitely out there on the extreme end of the decentralization spectrum, that 35-person HQ. It really acts almost purely as a capital allocator and a financial controller. They actively avoid providing operational services. Now, contrast that with a peer like AdTech. AdTech is still very decentralized compared to, say, a typical U.S. conglomerate, but they do offer a higher level of centralized support to their subsidiaries.
Okay, what kind of support does AdTech offer that LIFCO doesn't?
AdTech provides actual group-wide services, things like centralized financing options, help with managing foreign exchange risk, maybe some group purchasing power leverage, even consulting on ERP systems or providing central legal support if a subsidiary needs it. They offer tools, but importantly, the local manager has to choose to use them. It's not forced integration.
Ah, okay. So that highlights the strategic trade-off, doesn't it? AdTech offers potentially useful central services, which might boost efficiency locally, but also requires a bigger HQ and maybe creates a slight central bottleneck. LIFCO goes the other way. Maximum scalability for M&A, they can just keep adding companies without HQ size becoming a constraint, but the trade-off is minimal operational support.
Precisely. And it just hammers home that buy right imperative we talked about. If an ad tech company hits a snag with its IT system or needs help structuring a loan, the parent company can step in. If a LIFCO company runs into serious operational trouble, maybe a huge inventory pileup or a major supplier goes bust, that tiny 35-person head office is structurally and philosophically just not set up to parachute in and perform a hands-on fix. That subsidiary has to sort itself out, or the acquisition simply wasn't right to begin with.
Which brings us to the financials. This all sounds great, very elegant in theory, but does this super hands-off approach actually deliver the goods? Does it compound value effectively over the long haul?
Oh, the numbers definitely back up the story. LIFCO has delivered truly exceptional growth. We're talking about an average annual EBITDA growth of 18.5% between 2006 and 2024. That kind of long-term compounding just crushes most global benchmarks. But the really interesting part is when you look inside that growth and see the two distinct engines driving it.
All right, let's break that down. Using the recent data, say 2020 to 2024, how much comes from that steady M&A activity and how much from the more volatile organic growth?
Okay, so the acquisition engine. That's the reliable bedrock. It's like a steady coupon payment that just keeps coming. In that 5-year stretch, M&A consistently added somewhere between 9% and 18% growth every single year. Rain or shine, they're bolting on new earnings. This is their strategic cushion against cycles.
So that's the predictable baseline, which means the organic growth must be the wild card, right? The variable kicker that decides if it's a good year or a truly spectacular year.
Exactly right. Organic growth is highly cyclical. It really depends on what's happening in the broader global industrial economy. And look at the swings. In 2021, remember that post-pandemic boom? Organic growth gave them a massive 21% boost to the total. Huge tailwind.
Wow.
But then fast forward to 2024. The global construction and industrial sectors cooled off significantly, especially hitting that demolition and tools segment hard. And what happened? Organic growth actually turned into a negative 4% drag on the group's overall EBITDA growth.
Okay, that paints the picture perfectly. The strategic value of the M&A engine is crystal clear. They use those constant acquisitions to smooth out the bumps from their more cyclical businesses, like construction equipment. Acquisitions kept the overall growth positive in 2024, even when the organic engine was sputtering.
And this leads us directly to the profitability metrics, which is where you really have that aha moment about just how good the underlying businesses they buy are.
Okay, give us the numbers here, because I remember seeing a really stark contrast in the return on capital employed ROCE analysis. That seemed pretty revealing.
The quality just shines through. First off, their consolidated EBITDA margins are high and remarkably stable, even expanding slightly to 22.6% in 2024. But yeah, the ROCE analysis really tells the tale of capital efficiency. If you calculate ROCE, including all that goodwill that builds up on the balance sheet from buying companies.
Which is the standard way most people look at it.
Right. Even including goodwill, the return is a very healthy 20.9%. That's already excellent for any kind of diversified industrial group.
Okay, respectable. But then there's the kicker, the number that really shows how asset-light these businesses are.
This is the one. If you calculate ROCE excluding the goodwill, so looking at the actual return generated purely by the operating assets the subsidiaries use day to day, the tangible stuff, that number was an incredible 128% in 2024.
128%. That figure is almost unbelievable in traditional manufacturing or distribution. What is it about these niche businesses structurally that lets them generate such an astronomical return on the actual physical assets they employ?
It just proves that buy-right strategy is working incredibly well at the most fundamental level. They aren't buying businesses that need massive factories or huge fleets of trucks. They're buying companies whose value is tied up in specialized know-how, sticky customer relationships, proprietary software, defensible brands, mostly intangible stuff. These businesses require very little ongoing capital expenditure relative to the profits they generate. So the denominator in that ROC calculation, the actual capital employed in operations, is tiny, while the numerator, the profit, is high and stable. The capital efficiency is basically baked into the niches they target.
That's phenomenal. But does hitting a 128% ROCE, excluding goodwill, create pressure to keep CapEx maybe too low? Could they end up starving these businesses of the investment needed to stay ahead long term? That's always a danger with purely financially driven models.
That's a valid concern, absolutely. It's a risk in any model focused heavily on capital efficiency and cash extraction. LIFCO's defense against that seems to be twofold. First, remember, they leave operational decisions, including investment levels, largely to the local managers who supposedly know what's needed. Second, those sustainability metrics they introduced as part of Step 4 of the post-acquisition playbook. That forces local management to explicitly think about and plan for the long-term health and investment needs of the business, aligning with that perpetual hold philosophy. If the underlying businesses start to wither due to underinvestment, Lifco's whole safe haven reputation gets tarnished, which hurts their ability to buy the next company.
That makes sense, a reputational check and balance. Okay, this financial picture sets the stage perfectly for what's been happening recently. You described this sort of conflict between the cyclical drag they felt in 2024 and the conviction shown by management. First off, despite those headwinds, did the M&A engine keep firing?
Oh, absolutely. The acquisition pace didn't miss a beat. That really underscores their commitment to just keep compounding, regardless of the short-term economic cycle. They closed deals for 13 new businesses in 2024 and then kept up that relentless pace, adding another 13 in just the first 9 months of 2025.
Wow, that's 26 new companies bolted on in less than 2 years during a period of uncertainty.
Exactly. 26 high-quality niche leaders added to the portfolio.
Can you give us a couple examples? What kinds of things were they buying in 24 and 25, just to get a flavor?
Yeah, it shows the strategy continuing. For that big system solutions segment, they bought Maximover in the UK, remember, the specialized van
Uh,
conversions? Very niche. In dental, they added Citizen Imaging in the Netherlands, bringing in specialized dental imaging software, and also Nobile Bioresearch in Italy, which focuses on things like custom surfaces for dental implants. It's constant, small to medium-sized, specialized bolt-ons, often happening in parallel across different segments rather than big, splashy, transformational deals.
okay, but all this steady M&A was happening against the backdrop of what you call the core conflict of 2024. You mentioned organic growth went basically flat, slightly negative even.
That's right. For the full year 2024, organic growth was just barely negative, -0.5%. 0.5%. And this was the moment when that operational drag thesis really started getting attention from analysts and the market. It was driven almost entirely by the slowdown in industrial activity, specifically hitting them hard in demolition tools due to the weak market situation there. Global construction cooled, fewer demolition robots sold, simple as that.
Right, so the bears started arguing, see, this giant, hands-off conglomerate is finally getting too big, too unwieldy. Radical decentralization means they can't react effectively when a whole sector slows down. But then the 2025 results started coming in, and they seem to tell a different story, a counter story.
Yes, and the sequential recovery in 2025 is absolutely critical here. It directly challenges that narrative that the 2024 weakness was some deep structural flaw in the LIFCO model itself. Instead, it suggests it was largely cyclical. Organic growth bounced back quite strongly, hitting plus 4.3% for the first 9 months of 2025.
Okay, positive again.
And importantly, it even accelerated within that period, hitting plus 4.9% just for the third quarter of 2025. This sequential acceleration strongly suggests two things. One, the underlying markets, particularly construction industrial, are indeed recovering. And two, perhaps more importantly, for the LIFCO model, the local subsidiary managers kept their businesses resilient through the downturn and were able to capitalize quickly as the market turned back up. The decentralized model didn't break.
And if the improving numbers weren't enough as a signal, management themselves sent a pretty loud message, didn't they? Let's talk about those insider purchases in the second half of 2025. This feels like management really putting their money where their mouth is.
Yeah, this is arguably the strongest qualitative signal in the whole story we've looked at. This buying wasn't trivial. It happened right after the share price had taken a hit because of those 2024 operational worries and that negative organic growth print. The CEO, Per Waldemarson, made a very significant personal investment, buying KR 37 million worth of shares.
37 million krona. That's serious conviction.
It is. And then he followed up later with another SEK 5.2 million purchase. On top of that, a group of 4 insiders collectively bought another KR 17 million worth.
So the very people who have the absolute best, most detailed, non-public view of what's actually happening on the ground, the people who know exactly what the order books look like in demolition and tools, what inventory levels are, they saw the market sell off their stock and they stepped in and said, nope, we're buying this dip and we're buying big because the long-term story is intact.
That's the unmistakable message. It signals tremendous management conviction that, look, the operational rough patch is over, it was cyclical, and the true long-term compounding value of LIFCO wasn't reflected in that temporarily depressed share price. It's a powerful dose of skin-in-the-game reassurance for any investors who are worried about a structural breakdown.
Okay, let's pivot slightly to capital allocation philosophy because it really underpins everything we've discussed. We know the main use of cash is M&A, reinvesting those subsidiary cash flows. But you mentioned a critical detail earlier about their history, or lack thereof, with issuing new shares.
Yes, and this point is absolutely crucial for understanding how they've created so much value for shareholders. Lifco has not issued any new shares since they went public back in 2014. None. All that impressive double-digit EBITDA growth, all those 257 companies they've added, it's all been funded purely by the cash generated internally by the businesses and by taking on debt.
Which means every time they buy another profitable company, the earnings boost flows straight to the bottom line for existing shareholders. There's no dilution drag. It's incredibly accretive growth.
Exactly, which brings us right to the heart of the value proposition for public market investors, the M&A arbitrage mechanism. This is the beautifully simple yet powerful way Lifco leverages its reputation and structure to essentially create value out of thin air, financially speaking.
Okay, lay out the two sides of that arbitrage for us,
Okay.
because this really explains how the model makes money for investors.
Okay, side one. Lifco's buying price in the private market. Because of their safe haven reputation and perpetual hold promise, they can often acquire these really high-quality niche leaders for disciplined multiples, typically in the range of 5.8x to maybe 8 by EBITDA beta. They're buying great assets at prices usually reserved for, frankly, less attractive companies. That's the buy low part.
Okay, 6 to 8 times earnings for private, high-quality niche leaders. Then side two. Once Lifco owns that company and its earnings are consolidated into the group, how does the public stock market value those exact same earnings?
The public market sees those earnings as part of the stable, proven Lifco compounding machine, and so it values the entire Lifco conglomerate at a much, much higher multiple, often an EBITDA multiple of 25x or even higher. That private asset gets instantly re-rated financially the moment it becomes part of the publicly traded Lifco group.
Wow. Okay, so Lifco's core business, if you look at it purely financially, is acting as this trusted intermediary. They use their unique cultural position to buy specialized private assets relatively cheaply, say 7 times earnings, and the public market immediately says, okay, now that Lifco owns it, those earnings are worth 25 times, because investors trust Lifco's management track record and stability. That arbitrage is the engine driving shareholder value, and it explains that persistent premium valuation.
It's basically the institutionalization of a valuation gap. They use their non-replicable advantage that we never sell, promised access deals others can't get on the same terms, and they systematically capture the difference between private and public market valuations.
And obviously, a model built on constantly doing deals needs fuel. It needs a strong balance sheet. It needs dry powder. What does Lifco's financial structure look like today? Do they have the capacity to keep this M&A engine running hard without having to issue those dilutive shares?
Yes. Their balance sheet is actually remarkably conservative, and that gives them not just resilience if things get tough again, but also real strategic firepower during downturns, which is often the best time to buy assets when prices are lower. As of the third quarter of 2025, their key leverage metric, interest-bearing net debt to EBITDA, was super low at just 1.3x.
1.3 times.
Mm.
And you said their internal target, their ceiling, is 3 times. So they are running way, way below their own comfort level, even after buying 26 companies in under 2 years.
Correct. Their stated maximum target is 3.0x. So this very low current leverage means they have significant immediate financial runway. Being this conservative means they likely have the capacity to deploy somewhere in the neighborhood of an estimated SEK 10 billion to 15 billion more into acquisitions, just using debt, while staying comfortably within that 3.0x target range.
Okay, so that low leverage is essentially guaranteed fuel for future M&A growth, just waiting to be deployed. It ensures the compounding engine can keep running at speed, assuming they find the right deals.
Exactly. The capacity is definitely there.
All right, so we've established Lifco as this, arguably best-in-class compounding machine, leveraging unique cultural factors and this powerful financial arbitrage.
Yeah.
But all that success has led to a pretty hefty valuation, which means we absolutely have to talk about the risks and that final tension between the bull and bear arguments.
Yeah, Lifco definitely trades at a persistent premium. Those current multiples you mentioned, PE over 45 times, EBITDA around 25.6x. They're right near the top end of Lifco's own historical range, and also right up there with its closest serial acquirer peers, almost identical to Lagercrantz, for instance.
And a 45x PE, that's basically pricing in perfection, isn't it?
All right.
The market expects flawless execution, continued high-speed M&A, no major operational stumbles. It doesn't leave much room for error, much margin of safety if something goes wrong. So what are the key risks that could potentially trigger a painful correction from these levels?
We can break them down into 3 main categories based on the sources. The first is external and maybe the most structural.
M&A competition risk. The very success of the Swedish model has attracted a lot more capital chasing similar deals. You've got the established players like Indutrade and Latour getting more aggressive, maybe new players trying to copy the playbook. This intense competition creates a real risk that those private market acquisition prices get permanently bid up, maybe significantly above that historical 6-8 EBITDA sweet spot. And if that happens, if they start having to pay, say, 10 or 12 times EBITDA regularly, the arbitrage shrinks dramatically. That core mechanism of buying cheap and getting re-rated starts to erode. They'd need much higher organic growth just to justify the current stock price. Okay, what's the second risk? More of an internal vulnerability.
That's the operational drag thesis. This really came into focus during that 2024 slowdown. The core worry here is that the super decentralized, extremely hands-off model is just inherently ill-equipped to handle major operational problems when they inevitably pop up in a conglomerate this large and complex, especially when exposed to cyclical industries. If another global recession hits their industrial or construction segments hard, that tiny 35-person HQ simply cannot step in and orchestrate fixes across dozens of struggling subsidiaries. It could lead to prolonged periods of operational underperformance that the model isn't built to address centrally.
Right. The model works brilliantly when things are good, but maybe lacks the tools for deep intervention when things get bad.
Yeah.
And the third risk, this one's pretty common in founder-influenced or CEO-driven success stories.
Yeah, it's key person risk. Lifco's incredible track record, especially in disciplined capital allocation, is very closely associated with the current CEO, Per Waldemarson. He's the champion of this radical decentralization. On top of that, the company is still effectively controlled by its founder, Carl Bennett, who holds about 69% of the voting rights.
Wow, 69%.
Yeah. So you have this extreme concentration of strategic direction and ultimate control in just two individuals. Any unexpected departure or even just a significant change in philosophy from either Waldemarson or Bennett could create huge uncertainty for the market about the future strategy and potentially trigger a derating of the stock, regardless of how well the underlying businesses are doing at that moment.
Okay, let's try and synthesize all of this for the listener, the final shootout. Bull versus bear. Based on everything we've unpacked, if you had to boil down the bull case for Lifco right now into just a couple of key sentences, what would they be?
The bull case is fundamentally about conviction and capacity. It says Lifco is a proven, best-in-class compounding machine, that 2024 dip. Purely cyclical, as proven by the strong Q3 2025 organic growth rebound. Management's massive insider buying screams conviction that the worst is past. And critically, that super low 1.3x leverage means they have billions in dry powder, a multi-year runway to keep executing their core M&A arbitrage using cheap, non-dilutive funding. The machine keeps running.
Okay, compelling. Now, flip side. What's the concise bear case? The narrative that challenges this picture of smooth sailing ahead.
The bear case argues Lifco is essentially a victim of its own success, now saddled with a valuation that demands perfection. Bears would say it is suffering structural operational drag because it's just too big and decentralized to effectively manage cyclical downturns across the board. And crucially, they believe that M&A arbitrage advantage is eroding because increased competition will inevitably push private market purchase prices higher. So any sustained slip in organic growth or any sign they're overpaying for deals could pop that premium valuation bubble pretty quickly.
All right, so for listeners who are tracking Lifco or maybe just interested in the serial acquirer model generally, what are the specific concrete metrics they should be watching in the coming quarters to see which narrative, bull or bear, is playing out?
I'd focus on three key things. First, keep a laser eye on organic growth. That Q3 2025 number was plus 4.9%. The bull case needs that to be sustained, ideally even accelerate a bit, especially in that bellwether demolition and tools segment. If organic growth stalls out again or dips negative, the structural drag argument gets a lot stronger no matter how many deals they do.
Okay, organic growth first.
Second, watch the acquisition multiples. This is harder to track precisely, but look closely at management commentary, press releases about acquisitions, and analyst reports. Is there any evidence, even anecdotal, that the average price they're paying is consistently creeping up, maybe above that historical 8 by EBITDA ceiling? That's the direct measure of whether M&A competition is truly eroding their arbitrage advantage.
Got it. Check the price tags. And
Finally, monitor their leverage. They're sitting at 1.3x net debt EBITDA now. If they are genuinely finding plenty of high-quality deals at their target prices, that leverage number should steadily climb towards their 3.0x target ceiling as they deploy that dry powder. It shows the capital engine is firing on all cylinders. If leverage stays stubbornly low for a long time, it might suggest they're actually struggling to find enough attractive deals that meet their strict criteria, which would slow the compounding.
Those are great practical takeaways. Thinking back on this whole discussion, it really seems like the entire premise of Lifco's radical decentralization, their whole financial structure, hinges so heavily on that unique cultural element you mentioned earlier, that high-trust Nordic society, which allows founders to truly believe Lifco will be that perpetual owner.
It feels like their secret sauce, doesn't it? Maybe a non-transferable competitive advantage rooted in culture.
Exactly. So here's the final provocative thought we want to leave you with. Lifco currently gets only about 10% of its business from the huge U.S. market. The U.S. is generally seen as a lower trust environment, certainly more litigious, and arguably has a more complex, maybe cutthroat, M&A scene for private deals. So the big long-term question for Lifco and for anyone studying this model is this. Can a truly radically decentralized, super hands-off business model, one that relies on trust and simple private deals, actually succeed and scale significantly outside of its supportive Nordic home base, especially in a market like the U.S.? It's really a test of whether that specific cultural advantage can travel.
Yeah, that's the billion-dollar question, isn't it? If the LIFCO model works just as well at scale in the hyper-competitive American industrial landscape, then maybe it's not just a Swedish phenomenon, maybe it's a truly global blueprint for compounding. But if they struggle to replicate it effectively in the U.S., it might just confirm that the Nordic cultural moat is very real and perhaps geographically limited.
Something for all of us to watch. Thank you for joining us in the deep dive. We'll catch you next time.